Good morning and welcome to the weekly commodity market update. I'm your host, Will Robinson with Brownfield, joined as always by the University of Missouri's Ben Brown. Good morning, Ben.
Morning, Will. Hope you had a good week. Hope you enjoyed the holiday.
Yeah. Actually, some good news on your front. Maybe my youngest sister actually visited K-State this past week, so that might make an old K-State guy happy.
Yeah, let her come over here to Mizzou. We'll talk to her at Mizzou too.
So, all right. Well, looking at this week, it was a little bit of an odd week with an off day on Monday for the markets. But Ben, can you give me a market recap? What did we really see last week coming into this week?
Yep. And so the markets were closed yesterday. So everything is delayed a day this week in terms of report wise. We normally do a recap with the end of close or with the close on Monday, but given the markets were closed yesterday, we're doing as close from the overnight session today. Old crop corn for March was up 6 cents to $6.61 or dollars per bushel. New crop corn for December was up 2 cents to $6. That's really the first time the new crop corn contract has traded above $6. So hitting a kind of a ceiling or a theoretical ceiling mentality there, and we'll see how that responses now that it's broken that ceiling. Old crop soybeans for March up 46 cents to $16.16. New crop soybeans for November up 28 cents to $14.70. Looking at the components for soybeans, that soybean oil contract was up 3 cents. Soybean meal was up $2.20 per short ton. Turning to the wheat complex, old crop wheat for March was up 10 cents to $8.09. And then new crop wheat for July up 11 cents to $8.12 on the week.
What type of adjustments did we see to the basis last week?
Good question. So basis was mixed across the country for both corn and soybeans. On the corn side, the upper plains was pretty weakened on the week and flat for the rest of the country. On the soybean side, the river market, especially that Mississippi River market, was down 10 to 15 cents, but the rest of the country experienced increases in basis in the neighborhood of 3 to 10 cents.
Gotcha. So we're gonna, obviously start today a little bit different. So we're gonna look at highlights from last week. So Ben, what were some of the trading highlights? What were the drivers?
Yeah. So last Tuesday, right after we recorded, the National Oilseed Processors Association released their January estimates for soybean crush. As a reminder, this is about 95% of what is crushed in the United States, or their association represents 95% of the soybeans crushed. The expectation was for a very strong report, beating the all-time record. However, the January crush estimate by NOPA came in well below average expectations and even fell 1.5 million bushels below even the most pessimistic estimate. On the ethanol side, for domestic ethanol production, we saw that increase 15,000 barrels per day for the most recent week of data. And then stocks also increased, putting downward pressure on ethanol prices. Weekly export sales for corn, soybeans, and wheat fell within trading expectations. Old crop soybeans had another strong week for total sales as buyers around the world look to the U.S. to kind of shore up some deliveries for this summer. New crop soybean sales for the September moving forward also saw some strong numbers. And then managed money holdings, or the speculative trade holdings for corn, soybeans, and wheat futures, remain at elevated levels, but did shed 5,684 contracts on the week. The cuts for corn and wheat were more than offset the increases in the soybean complex.
Just kind of a follow-up to that, looking at how high soybeans especially are propped up, do you see, that maybe the price might limit its action looking at fundamentals on the upside just because of how high the market is?
So that's a great question. We did see that bearish report from a domestic standpoint by the National Oilseed Processors Association, caught a lot of traders offhand. The market largely took it in stride, mostly from the standpoint that up until this point, we'd been seeing very strong domestic demand. Now that's kind of flipping. Our domestic demand is weakening a little bit, and the international side is what's picking up, especially as buyers around the globe look to the United States as a source of delivery for this summer. We've seen U.S. be competitive in those summer months when we're typically not. Usually South American soybeans are priced at a competitive level usually cheaper to buy South American soybeans than U.S. soybeans, but that's not been the case for in some cases, some months for summer delivery and even into the new crop. And so we've seen countries pick up some purchases of soybeans, which has been good. The downside, I think, here is we've seen this picture before where there's been concerns about South American soybean production, and it hasn't been as bad as what many analysts had thought in previous years. Now, whether that shakes out this year or not is yet to be seen, but certainly while the fundamentals domestically for domestic soybean demand have cooled off some, the international market is picking up and taking their place, and that's pushing soybean prices higher.
Looking on the energy side of things into ethanol, you mentioned that just a little bit in your highlights for the week. So we saw some production increases, but what are the market implications there? What are your expectations?
Yeah, so we did increase ethanol 15,000 barrels per day last week, which was a positive sign after we kind of decreased production the last couple of weeks prior to that, and we sit about 7.5% better on the week than we were the same week in 2021, right in line with the 5-year average for the week. So it's one of those things that we've seen strong ethanol margins. When we look at total corn use for the marketing year so far, we continue to run 9.5% better than the same period last year. USDA continues to call for about a 6% year over year increase in corn used for ethanol. However, we've seen some downward pressure on ethanol prices as stocks have built. Those ethanol prices have fallen below $2. However, ethanol profitability, while it's fallen, we've gotten some support from high oil prices, and I think that's kind of the story going forward, especially when we think about what this Russia and Ukraine situation could mean for higher oil prices. That translates into higher ethanol use as well. And so with higher oil prices, that's pushed ethanol prices back above $2 on the week. Oil prices continue to strengthen. The West Texas Intermediate crude is trading above $93. The Bent crude is trading above $97 a barrel, and many think it'll get to $100 in the next day or two. These are the highest levels we've seen since September of 2014. Globally, there's been challenges at revitalizing some of the lost production due to COVID. There was an interesting article that was floated around this last weekend that even at these higher price levels, suppliers of oil have been resistant to add additional production because they're trying to recoup some of their losses due to COVID and basically return some of those profits back to shareholders. So we talk a lot about a cartel overseas, but that certainly implies that there's some at least coordination happening here in the U.S. shale oil market too. So we've seen some increases since August of 2020. Active oil rigs in the United States have increased from 172 oil rigs to 516. So they have increased, and that's economics working. As prices go higher, it encourages more production into the market. But even with the prices we're seeing, we would expect some more entrants, and we just haven't seen that increase in production to match that yet.
So talking about Russia and Ukraine, and its impact on the fuel market there. So are there any, I guess, new factors that have been introduced in the last week or so within that? Or is it really just largely the same tensions that are going to continue for, however long?
Well, yeah, it's really ramped up the last couple of days. For anybody that's been following in the news, it's pretty much dominated the news cycles the last couple of days. This standoff with Ukraine and Russia, and I don't even know if it's a standoff anymore. It seems like we've actually got some action that's happening. Continues to progress. As we thought we had some diplomatic progress last week, but then yesterday, Russia declared 2 regions of Ukraine as independent and ordered troops into those regions. That is kicked off sanctions by trading or partner countries of the U.S., allies of the U.S. The U.S. has yet to impose sanctions on Russia, and really deciding on which restrictions to impose is tricky. Hitting the sector that would do the most damage to the Russian economy, which would be oil and gas, would also cause the biggest problems in the U.S. and Europe, as companies and people, primarily voters, right, are already dealing with high oil prices, and we talked about that. So it is tricky in terms of what they're going to do. President Putin, his television speech yesterday was largely a 1 hour program dedicated not necessarily at Ukraine and the Ukrainian government, but really directed at Western governments and what he feels has been a 3-decade attack on the influence of Russia. And so he kind of maybe tilted his hand a little bit there and expressed what he really wanted. Now, what he wants, I think, is unpalatable to the U.S. government and frankly to U.S. elected officials in Congress. And so how they handle this is going to be tricky. But it does have implications for commodities, and it depends very much on the commodity. For products that Russia exports a lot of, like oil, corn, and wheat, this is a bullish signal to U.S. producers. We can pick up some of that market share as their trade out of the region is limited. Conversely of that, products where Russia and Ukraine are large importers, like meat and dairy, have bearish impacts for U.S. producers. So there's some trade-offs there in terms of which commodities you're looking at and whether you're a producer or a buyer of it. If you're buying corn for feed, you might not like seeing corn and wheat prices move higher.
So is there any, risk, or how much risk is there that if and when the U.S. does impose sanctions against Russia, that will be another large driver into the market for corn and wheat?
So I'm hesitant to respond because I don't know. I'm puzzled as to how the U.S. is going to respond. Germany responded by cutting off a major pipeline of gas from Russia into Europe, which is significant because without it, Europe probably faces some major energy shortfalls as we head into the winter. So that's they've taken what I would call to be an aggressive approach, but it also could have large ramifications to their citizens. The United Kingdom has put sanctions on banks that are controlled by Russian individuals or state-owned Russian banks. So the U.S. has a wide range of options. As I mentioned, if it hits the largest or the sector of their economy that would hurt the most, it would certainly drive oil prices higher here, and we would see shocks in other commodities, all the commodities as well. So it's hard to say. I will say that we use the VIX, the Chicago Board of Trade's VIX index, which is kind of like the fear. It's a combination of put options, and it tells how much, or it captures the fear on Wall Street. It's trading back at or above 30, which is kind of a significant threshold. Just in terms of observation, it's hard for any commodity to support a bearish run when the VIX is trading above 30, just because there's such a risk-off presence in traders. So we'll have to see.
And then shifting gears, I guess, looking to our far neighbors to the south. Any updates on South American weather and how that could be impacting the market?
Yeah, we continue to see production estimates in South America continue to decline. It's been hot and dry in southern Brazil, Argentina, and Paraguay, which is it's where we've seen the biggest part of the damage. It's been confirmed by estimates from USDA, CONAB, which is the Brazil equivalent to USDA, and then the Buenos Aires Grain Exchange, which is the Argentina equivalent to USDA. So, we started off with very robust or optimistic outlook for South American production, looking at producing roughly 210 million tons of soybeans out of the region. That's fallen all the way down to 175 million tons, or basically 35 million bushels less than where we expected to be. So that's had big implications in terms of the soybean complex, and that's why we've seen this run up. I will remind people, and I have 2 points that I think are important for South America, is that it's not likely going to be a 1-for-1 substitution on soybeans. Just the fact that South American production is down and their exports will likely be down does not mean that all those exports then come to the U.S. Higher prices will limit international buyers' palette for products. And so my first point is the U.S. could pick up some exports of South American demand, but it likely won't be all, because some of that will just disappear on higher demand. My second point is timing is everything. even with the prospect for a smaller South American crop, including shipping across, soybeans are in Brazil are still cheaper than US soybeans through some of the summer months. And so we might not get, even though people are buying old crop soybeans for delivery this summer, those might end up getting rolled into the new year, just given the timing of things. And so outside of another ill-timed hurricane, like what we saw last August, that really limited our shipping out of the Gulf right at the peak of our season, right there at the beginning of September, we should see some robust exports in late August and September from the United States. But again, whether it's this marketing year or next marketing year, has some implications there. Exports would be good for U.S. soybean producers that want to sell their product, but timing does matter.
All right. Well, just on that, if viewers want to learn more or watch the market more for those reports, the USDA's export inspections report that is out today. Ethanol report is out Thursday. County yield estimates for corn, soybeans, and sorghum is Thursday. And cattle on feed comes out Friday. Everything got moved back a day from President's Day on Monday. So reports to watch there. Thank you for joining us. If you want to watch or learn more, you can check out brownfieldagnews.com for more ag news and more podcasts like this one. Ben, thank you for joining me this morning.